All right, welcome to your market bias recap report for Sunday, August 13th, traders. This is Jeremy Johnson coming at you hot. Diving right in, I'm only going to cover a few of the futures today, and I'm just going to go over the most important ones that are kind of driving the rest of the market to save you guys from time and focus in on what's most important this week. The S&P 500, we are currently sitting on the 50-period moving average. We did have a doji on Friday right at that 50-period moving average support that kind of corresponds to the horizontal support over here from the left of the chart. Short version, this is a very, very important support test. We really have to hold this level. If we look at our RSI and our MACD, both of them are showing bearish. We got our bearish signal here, and we have now obviously been putting in lower lows and now a lower high right there. And this is now confirming the bearishness that we were seeing in the chart instead of the divergence that we had been seeing back the last few months that I'd been talking about that was signaling that a rollover might be taking place. Now we are actually getting that momentum towards the downside. Same thing with the MACD. The MACD has actually crossed below the zero line now, which is considered bearish. So this is kind of a moment where it's either break or don't. And we really want to see this hold if we have bullish positions in our portfolio. Going out to the weekly chart here, you can see the level that we are at sitting on support on the 50-period moving average on the daily chart actually coincides very, very tightly with the rising 9 EMA on this weekly chart. If this gives out around 44.72, it is a fairly large gap to the downside down to 43.45. So that is kind of the target to the downside, this rising 20-period SMA, and also corresponds almost perfectly to the penny with the high of the swing high from back in like May. So anyways, if this does break, it's look out below for at least 100 points, if not 150 points to the downside there. If we do on the daily chart see this hold and get back above and close, importantly, close above the 9 EMA, we could see a little bit of a rally, but honestly, any rally that we have here, I am going to be very suspect of. I think we have a lot of either neutral or potentially retracement still left in the tank. The one saving grace here is that this has been a fairly orderly pullback. We haven't had any massive red candles like back here. We haven't had nearly as high of a volume as we had back here with these big red candles moving down and the big red volume as well. We got a volume spike here, but even here, this was like half of the volume that we had back here. So that is the one saving grace here, is that it hasn't been a panic sell everything moment. That kind of tells me that it's probably mostly being driven, at least as of now, just by profit taking at the top end of the chart. And when that happens, it's not unusual for the bulls to be able to come back in and reclaim their stride. But like I said, this is just a very, very important support zone on the S&P 500. So I'm being very cautious this week. I am favoring credit trades through the options market and just being very, very selective here. I'm probably not going to be doing nearly as much trading volume this week as normal. This is going to be kind of a wait and see week, waiting to see if either this breaks to the downside so that I can add some bearish trades, or if it stabilizes for a while to potentially reset and look to the upside again. But this needs to develop a little bit before we will be looking for that. Going out to the NASDAQ. Where we had the S&P 500 holding its 50-period moving average, this pinkish red line here. The NASDAQ has broken it, and actually its 9 exponential moving average, the shorter term moving average, has actually broken below that 50-period moving average as well. And that is considered a bearish signal. So anyways, this has some work to do. Honestly, in my opinion, this is probably going to grind lower for a little while yet. You can also see that we have broken both of our trend lines, the one starting back in beginning of May through until kind of this topping pattern we had right here. We broke that with a higher volume and a big nasty red candle, and now it has just been trailing lower ever since. And if we go out to the weekly chart, you can see we not only broke our lower longer term trend line here, but we also broke the 9 EMA. So anyways, best case scenario is going stagnant sideways for a little while, letting the bulls kind of recover and try to make a push higher again. More likely scenario in my mind is that we have more downward pressure in the tech sector to go, and that most likely will lead us to 14,845 here, this first trigger that correlates to the low of this week about a month and a half ago. And if we break that, coming back down to the rising 20 period moving average on the weekly chart, down at 14,500, 14,520, somewhere right in there. Heading over to the Russell 2000. The Russell 2000 is holding up better than the other two indexes we've looked at so far, where they have broken a lot of support. The Russell 2000 is still holding on to its 50. It is still getting pressured by the 9 to the downward side like the others are. But I'll point to two different things here that I kind of like about the Russell 2000 if it can gain some traction here. First one is it hasn't broken our most recent uptrend diagonal support line here yet. You can see we are still sitting right on top of that, and it kind of roughly tracks the 50 period moving average here as well. So we are holding the 50 period moving average. We're holding our most recent diagonal support line, and we are actually also holding our horizontal support line that is played as important support and resistance in a couple of the most recent major price pivots in the market. So we have three different really important support zones kind of colliding right here. So this is very important on the daily chart for this to hold. The MACD is signaling bearish. The RSI is signaling bearish. It is under 50 currently. That's kind of our line in the sand for bulls versus bears. And then if we go out to the weekly chart and zoom in here a little bit, you can see that today's open, we are still holding the rising 9 on the weekly chart, and that also correlates to the same zone with the diagonal support, the horizontal support, and the daily 50. So actually we have 4 different really strong support zones kind of colliding right in here. So if the bears do get through that, it's going to be lookout below, and I wouldn't be surprised to see it drop all the way back down here, probably to around 1875. But it's going to be a fight for the bears to actually get through that because there is a lot of support. Ideally, I would love this to just go sideways and hold the rising 50 period moving average in this horizontal support zone here between that and the decreasing 9 for the majority of this week. Give it some time to reset and then try to break out to the upside for any bullish positions. But again, just like the other two charts, this one needs a little bit of time. So I'm going to be very, very careful with trading this week on that as well. Finally, going out to the Dow Jones, our fourth major index. Dow Jones is holding up okay. It is above its daily 9. It's below its rising 20 here, though, and I can kind of zoom in a little bit so you can see that. It is just getting pinched, this itty-bitty little candle right here, trying to figure out what direction it wants to go. If it does get back up above the 20 period moving average, honestly, there's not really a play here in my mind because we do have the decreasing resistance line right there on top of us. If it breaks down, it's probably coming back down to either the lows of these candles here around 35,100, or if it breaks that, coming back down to 35,000. So those are kind of the two lines in the sand on the daily chart. Just throwing it out to the weekly real quick to confirm our bias and see if there's anything else we see. And this actually confirms that kind of 35,000 mark as well, because it's not only this major horizontal support and resistance line from over a year of price action coming up and testing that zone. We also have the rising 9 coming into that zone. So we do have a ton of support here, and the MACD and RSI are still bullish on this. But it's going to be a fight, and it's going to be a hard fought battle. Of the 4 major indexes, the Dow Jones is actually the most interesting spot to me right now. So I'm going to be looking for safety plays in big, very established companies with good dividends, and hopefully good options contracts and the liquidity that I can cash flow on. So that's going to be kind of my system going into the week ahead. And we can confirm that actually coming out here to our heat map. So this is showing the 1 week percentage move of different stocks throughout the S&P 500 and larger market as a whole over the last week. And you can see tech is just getting slaughtered. All of the big red that you see on this screen is basically all the tech sector. And what's doing good? We're getting healthcare, consumer discretionary, energy, industrials. Those are all components of the Dow Jones. So that kind of lends itself to this idea of looking for those big blue chips with dividends and hopefully some options to play. So that's kind of the area of the market you want to focus on this week. If we go out and look at UUP, been all over the place over the last week. We had a gap down and stabilized, gapped back up, pulled back, and now we are breaking out, unfortunately. So if this continues higher, this is not good for the market. It probably means that stocks are going to struggle and break down even further if this chart continues to the upside. And if we toss this out on a weekly chart, it is going to be very, very important for us to stay below this 2872 level. If we break out of that on the weekly chart here, there is really nothing stopping it from skyrocketing back up to 30 or more. And that would cause some serious chaos in the market. So we really, really want to see this stay below there if we are going to have any kind of a bullish posture. Just looking out, so this was... When was this? This was in early October, late September, early October. So just to show you that, let's go back out to the S&P really quick. Early September, where are we? Yeah, September and October. So that correlates to this drop right here, all the way down to our very peak lows was that same time frame on UUP here. So if we get this massive ramp up like that, we can expect a similar kind of chaos coming into the market. Other than that, let's go out. Let's check gold real quick, guys. Nothing really to see here. Gold was trying to put in a good fight a month or two ago. Looked like it had some room to run. That $2,000, $2,025 mark proved to be too much for the bulls to handle. And with the economic data that we got in, it has kind of snuffed gold out. And with the pressure from UUP on the US dollar, it has just been a grind lower ever since. We are now actually threatening to break down of a major support level in gold. If this breaks, is look out below, probably back down to 1900. So if you have long-term gold positions, you don't want to sell for tax purposes or anything, sell covered calls, do some kind of option strategy to offset your risk to the downside, and look out below, because this does not look good, especially if UUP continues its spike. We are going to see a fairly significant drop in gold over the short term. And then finally, just because we've been tracking the reversal on natural gas for a couple of months now, let's pop out to natural gas real quick. And this chart is continuing to look interesting to me. Natural gas is a very hard instrument to play directionally. This is much better for cash flow trades. So if we, instead of looking at the futures here, we can kind of gauge what it's doing on the futures, and it has a nice doji sitting on the 9. And if we go out to the weekly chart, you can see it is really fighting the good fight to try to finish this rounding bottom pattern. This is kind of a cup and handle pattern. So if we break out of this, there should be some really nice appreciation. But like I said, natural gas is very hard to trade directionally, especially on the futures. So instead, if we go out to UNG, which is the natural gas ETF, this one is easier to play, and it also has options. So you can do some option strategies in here, and you can see it has plenty of liquidity and some good strike selections on every dollar mark. So the way to play natural gas, if you are inclined to do so, is either just stock trading on UNG or doing some kind of an option strategy on it. I kind of prefer selling naked puts. Right now, we closed last week at 750 or 749. Coming out to like the $7 naked put. Let's just see what we can get for that. So the naked put, we can sell for $30 for the 7 naked put. What is that? 7. Yeah, we can get like 4% return for over the course of the next 33 days. We can get about a 4% return in exchange for promising to buy 100 shares at $7. That's what selling a naked put looks like if the price continues to drop and closes below $7 in 33 days. So not bad for a stock if you want to own it long term, to get paid to buy it at about a 4% discount to today's opening price or Friday's closing price, I guess I should say, and also get paid a 4% premium on top of that. So not a bad play. I do really like cash flow trades on natural gas. As we wrap up here, just looking at quick market internals, the VIX is still ridiculously low. We had a bunch of volatility, bunch of wick nonsense here over the last week. Market trying to figure out where it's going to go. I do see the VIX probably continuing to work its way north here over the next week or two. And this is just a marker of volatility in the marketplace. So look out for a little bit higher volatility. That's going to impact options premiums. If we go out to the arrow high-low indicator, you can see we have gone from neutral and we are in bearish territory now. So this is pointing to potentially lower prices ahead across the market. And finally, in our advancing issues minus declining issues, this gives the net difference of how many stocks are appreciating versus depreciating on a day-to-day basis. And this has been trending lower. You can see this blue line right here. That is our 20 SMA. And if that is below the 0 line in yellow here, that is our bearish indicator. So we actually pierced it briefly on Thursday, recovered Friday just barely, but I am expecting that to cross bearish this week. So again, focusing on either neutral cash flow trades or potentially adding some bearish trades to the portfolio. Finally, to wrap up, guys, if we just go out to our Forex calendar here to see what the economic data coming out this week is that we need to be aware of. Tuesday, the 15th, 5:30 a.m., we have core retail sales. That'll be a very important one. Keep an eye on that. FOMC minutes on Wednesday at 11. Not expecting that to do a whole hell of a lot. Honestly, it's just kind of an update as to what they're doing, but the market, I think, kind of knows that they are quote unquote data dependent for a while and likely going to pause on the next rate hike, at least as of now. So not expecting this one to move the market a whole lot. Unemployment claims, if we get a big spike up on unemployment claims, that will be a really big indicator that the economy is slowing down quite drastically. So as long as this continues to just be somewhere around this 240, 250, somewhere in there, we should be okay. But if we do see a big spike up on that, that is going to be an important indicator to look out for. So anyways, hope that helps, guys. Trade safe. Keep your position sizes small this week. Be quick to take profits. And if you do get into the green on positions, don't be afraid to pull your stop losses up to at least break even more aggressively than you normally would to lock in those profits and prevent the trades from rolling over on you and turning into losses. Hope that helps, guys. Bye.